I published a new blog post earlier today, February 4th, 2026, discussing some of my trades over the past few days. A link to my blog post can be found in my profile section here at YouTube. There has been a rotation out of software stocks and other technology stocks into dividend paying stocks and sectors where most of my stock investments can be found, and that includes equity REITs, regional banks, consumer staples, and at least for today, packaged food stocks. Last Friday, a private AI company launched a product that many investors feared would replace or diminish the need for certain software products. I will leave two links in the More section below discussing this development. It is impossible for me to know whether this is a short, intermediate, or long-term threat to enterprise software companies or even poses much of a threat at all. I do not invest in those companies and have zero expertise in software. I would say that it is my current opinion that over time, AI will replace about 10% of the U.S. workforce. Several BDC stocks, business development corporations, have been hit over that same time period due to concerns about their loans to software companies. I discussed adding to one Blue Owl Capital in my post published earlier today. I will not devote much money to that kind of investment. I'm becoming somewhat concerned that the decline in cryptocurrency prices will spill over into other asset classes as some leveraged investors in Bitcoin receive margin calls forcing them to either sell more Bitcoin, which contributes to the selling pressure, or to liquidate non-crypto assets like stocks to meet margin calls. The risk appetite of some investors may also be diminished by heavy losses in the crypto since early October 2025. Bitcoin was trading at 72,175 as of 4:08 p.m. Central Standard Time this afternoon. The high was at $126,273 in early October 2025, or a decline of about $54,098 to the price that I just quoted, or about a 42.8% decline from October 2025 high. In my lifetime as an investor, there have been some assets that have declined that much over a short period of time. A lot of the catastrophic stock declines that I've lived through, including the one in 1974 and the other one that started in September of 2008, have been fairly sharp declines of that magnitude and bottom fairly quickly. But while I had confidence in investing in stocks after those declines, I simply, and that's because I can ascertain or formulate a rational fair market value for stocks. I cannot do that for Bitcoin. So the Bitcoin decline does not concern me. I am not invested in Bitcoin. My alternative to as an alternative to the U.S. dollar as a store of value has been and will remain gold and silver bullion. I discussed in a prior video the one-day meltdown last week in gold and silver prices in a prior video, and those metals have been in a recovery mode, unlike crypto, since that steep one-day decline. I did some light pairing today to stocks that were in a rally mode, and I had most of my portfolio was up today in stocks, my stock portfolio. What I will do is to profitably sell a few shares of a dividend-paying stock selecting the highest cost lots using whatever cost method achieves that result. In my Schwab account, for example, that can be accomplished generally by using first in, first out FIFO-based cost accounting, or by selecting high cost. I just click the link in the default method which in that account, which is FIFO, in the order box, and then it shows me a bunch of other alternatives that I can use, and one of them is high cost. The reason for this approach is primarily risk mitigation. As I explained in today's post, my stock exposure is reduced, my tax bite is minimized by selling the highest cost lots, which then reduces my average cost per share and increases my dividend yield. An example is discussed in today's post. I've been pairing my position in Stag Industrial, a REIT with the symbol STAG, for some time now. I've sold 5 shares at a $37.75 for a $92.61 profit, which reduced my average cost per share to $13.93 for 40 shares, and I have snapshots in my blog of all these transactions. And that increased my dividend yield at a new average cost to 11.12%. Another example was discussed in my prior blog post published on January 29, 2026, where I sold 5 shares of Williams Companies. It's an energy infrastructure stock, and I like those stocks. It's one of the areas where I invest in. The symbol is WMB at $64.85 for a $209.09 profit, which reduced my average cost per share in my remaining position to $22.80 and increased my dividend yield to 9.21%. So you could see what I'm doing there. Since I transitioned from a stock investor, which I was for most of my life, to primarily a bond and treasury bill investor over the past decade, and the bonds would be investment-grade corporate bonds and Tennessee municipal bonds rated AA or better, I have attempted to develop a number of risk mitigation techniques for my stock portfolio that I refer generally to them as small ball, a baseball analogy. I'm not trying to hit home runs. I'm just trying to collect dividends, sell shares at profit, and reduce my average cost and increase my dividend yield. While I will try to come close to an annual realized gain of $25,000 in stock and stock fund trading profits as a supplement to my interest and dividend income each year, I'm going to do that, or try to do it, with no more than 10% of my total portfolio held in brokerage accounts devoted to stocks, common stocks and stock funds, given my financial condition, which does not require me to take those kind of risk, and my now diminished risk tolerance given my age. So the strategy that I'm using and deploying and discussing in my weekly blogs is specifically tailored to me and my circumstances.